So which airlines are best positioned to cash in on this holiday travel bump, and how big of a role will falling fuel prices play? Joining us now is Jefferies analyst Sheila Kahyaoglu. Sheila, welcome. So you like Delta the best of the airlines, despite all of this loyalty program trouble they've had. Why?
Thanks so much, John. We're quite bearish on the airline sector, actually. The airlines have underperformed, with Delta the only airline up over the past 12 months. We like Delta for three reasons. One, the premium offering. Premium represents about 40% of sales, and that's really garnering a pricing premium. International, as an example, is up 25% on pricing versus 2019 levels. What we're seeing for Q4 pricing overall in the industry is down 10%. Some airlines are down as bad as 20%. So for 2024, as we look forward, we're seeing price declines on the industry on average of 2% versus year-over-year levels. But we think Delta could hold better pricing than most airlines, given their premium offering and their international offering. So that's really the biggest reason why we like Delta, in addition to a few other reasons.
Okay, but jet fuel prices are down too. How does that factor into your view of the airlines?
Jet fuel is about 30% of total operating costs for an airline. So, of course, as the macro concerns have gotten bigger, that's how helped jet fuel come in and is helpful. But the other side of the operating equation is also salaries. Salaries represent about 30% of total costs, and those are going up over the next few years, just given the pilot labor agreements, flight attendant agreements that we're seeing, and obviously overall inflation. Maintenance costs are also up significantly. They represent another 15%. So year over year, we're forecasting costs are up overall. So it's a matter of what airline could generate better revenues, and the revenue is coming not from capacity additions, but from pricing power. And Delta, we think, is the only one in the industry, just given where it's placed, its network. The losers in the industry are the low-cost carriers. With Southwest, we have a underperform rating on that one, just given the headwinds that they're seeing in their specific network. Delta also has a few ways to leverage their other platforms. Their SkyMiles business, their Amex program, we think could be valued at about $20 billion of enterprise value. And their Delta Tech Ops, think of it as an auto body shop for airlines. That could be valued at another $10 billion. So you're basically getting the airline portion of Delta for free in this equation on our math.
Okay, tell me about Boeing. When is it going to get back to those 2021 levels?
Well, when will it get back to 400 is the question we get from investors all the time.
And I was trying to be reasonable here.
You were trying to be polite to me. I get it. The story hasn't worked. Why hasn't it worked? Boeing hasn't been able to deliver aircraft. We think it's finally getting its act together when it comes to the two most important pieces of the aircraft, the fuselage as well as the engine. The fuselage is Spirit Aerospace Systems is the manufacturer of that. They had a CEO change just last month, put a Boeing insider in. We think that's going to help Boeing deliver the aircraft and eliminate quality issues. And engines, in GE, we trust when it comes to manufacturing LEAP engines. So we think those situations get better and Boeing delivers. But ultimately, getting back to that 400 price target we had back in 2018, that's a matter of Boeing getting rid of aircraft that have been sitting in inventory for the last 4 years. They have 250 737 sitting in a parking lot somewhere. Until they get rid of those aircraft with lower pricing, we don't think they get to $10 billion plus of free cash flow until 2026. And that's where the real upside comes. Of course, the stock will react prior to that.